Well, hello, everybody, and welcome to today's webinar on non-recourse loans within self-directed accounts. My name is Jason DeBono, Vice President of New View Trust Company, and I'm joined today with a good friend and someone in the industry I've gotten to know over the years, Roger St. Pierre. He's a Senior Vice President for First Western Federal. He's been with them going on 21 years, and First Western Federal is a bank that has specialized and taken specialty in non-recourse loans. And so we're going to talk today, and Roger's been kind enough to join us to share how the non-recourse loan program works, what it means within an IRA, and what the process is for going through and obtaining a non-recourse loan. First Western Federal started writing non-recourse loans back in 2008, and so we've had clients that have worked with them on loans for a number of years. And I just want to give a couple disclaimers and a couple of lead-in points, then I'm going to turn everything over here to Roger. While we're incredibly appreciative of First Western Federal and their willingness to join us and get Roger's expertise, I always have to remind everybody that we are a third-party custodian. We are non-fiduciary in nature. Nothing that we're going to talk about today is in any way to be relied on or construed upon as an investment recommendation or endorsement. And while we have lots and lots of clients that have utilized First Western Federal's non-recourse loan program, there are other institutions that do write these loans, and we would recommend certainly that all clients do their due diligence to find the right lender. So with that said, one of the biggest opportunities that self-directed IRAs provide is individuals not only to buy real estate, but to buy real estate with leverage. And so a lot of times people view self-direction as kind of a limitation because they're used to buying real estate with their personal funds, taking advantage of small down payments and being able to finance the rest. And if it's rental property, their tenants are making payments and ultimately covering their cost of ownership. Therefore, there's very little cost or money out of pocket for the investor. A lot of times people view self-directed accounts as losing that ability, and we're here to talk today about how that is still an active part of a lot of our clients' investment philosophy. And so while it's not apples to apples in terms of how you would obtain financing with your personal funds, I think you'll find, and with Roger's expertise today, understand that it's not a whole lot different. And the ability and opportunity to buy real estate with the power of leverage is fully available through self-directed accounts. So with that said, rather than us try to tell you how it works and the process, we've gone ahead and brought in an expert in this arena to come in and share his experience and expertise on non-recourse loans. So with that said, welcome, Roger. Thanks for being with us today.
Thank you, Jason, and all of the New View staff and company. I certainly really appreciate the opportunity to speak on this topic. It's a relevant one, and it's one that many investors who are investing in real estate, rental real estate particularly, are taking advantage of. So what I'm going to talk to you a little bit about today is the whole idea is leveraging real estate purchases within a self-directed IRA and how to use that leverage to purchase real estate. So with that said, I'm Roger St. Pierre. I'm the Senior VP, First Western Federal Savings Bank. We're in Rapid City, South Dakota, and we lend in all 50 states. And a little bit about our bank, we have been a portfolio lender for nearly 40 years. And so we hold all our loans on our own books. We don't sell any loans. And because of that, we're able to write loans at every state in the non-recourse space. And a little disclosure, First Western Federal Savings, we're not accountants or investment advisors. So we would encourage you folks that you account and take some time to spend with your financial advisors and your tax consultants before you do transactions to be sure that you're following the rules, regs, and all the manner that you need to do stuff within the self-directed space. So what is a non-recourse loan? A non-recourse loan basically is just a loan that's secured by the property itself. It is the collateral for the loan, but the bank has no recourse back to the borrower if there's a default. And what I mean by that is if the bank takes a lien or leverage on a rental property, for example, we only can collect the loan by payments from the IRA during the course of the loan, but should there be a default, all we can do is foreclose on the property. We cannot go after the borrower itself, which is the IRA. We cannot collect the loan from the owner of the IRA. That's an IRS regulation, and that's how they set these up from the very beginning, was so that the IRA owner is not responsible for the payment of the loan. And that, hence the loan non-recourse, just means the bank has no recourse back to the owner or the IRA itself if there's a default. And what kind of entities are acceptable? Well, any self-directed IRA that you have with NewView is absolutely acceptable. There's also kinds of retirement arrangements. They could be solo 401ks or IRA LLCs as well. We also lend to those kind of entities. More traditionally, though, what I see through the NewView client base, which we've been lending to for a long time, is traditional and Roth IRAs set up through NewView. So any self-directed IRA basically is an acceptable entity for a non-recourse loan. And properties are very wide open in terms of what kind of properties we will lend on. We'll lend on residential, that'd be single family, multifamily, apartment buildings, condos, vacation condos, commercial properties, warehouses, office warehouse, industrial, and farms even with income. If there's some ag land and you're familiar with that ag land and you can receive rental income from that from a farmer, that's acceptable collateral. So basically, we'll lend on any income producing residential or commercial real estate. Now, what is the qualifications? Well, as I mentioned before, the owner of the IRA is not the borrower. So we don't look at the owner of the IRA's financial picture. We don't get tax returns. We don't look at their financial statement because they're not borrowing the money. Their IRA is borrowing the money. So what do we look at? Well, number one is a good down payment. Because there's no recourse in this world, we want to make sure that there is a minimum chance of default. So we're going to look for about a 40% down payment on most properties. The other thing about putting a larger down payment on a property, though, is you get better cash flow, as you probably know. So that works to your advantage as an owner in that you have stronger cash flow with a bigger down payment. So think in terms of a 40 to 50% down payment, having your closing costs available in your account, because of course you're going to have closing costs just like you would have on any other real estate transaction, such as an appraisal, title company, title insurance. That's all the same, whether it's an IRA buying the property or you personally. So you need to have your closing costs in the account. And then also, in addition to that, 15% of the loan amount in reserves. We'll want to see money there on the sidelines because you need to pay Joe the plumber, for example. If he comes over and hands you a $1,500 bill for a new hot water heater, you can't just pay Joe the plumber out of your hip pocket funds. They must come out of the IRA. So that's why we want to see some reserves, some operating monies on the sidelines to be there to operate the property, pay payments when there's times of no tenants, or make improvements to the property in between tenants. Anyway, the bottom line is you need some money, just prudent business on the sidelines for operating monies, and that's why we require 15% of the loan amount to be in a liquid manner in the IRA. It could be stocks, bonds, mutual funds, or cash. So number one, does the IRA have the money? Two, does the property cash flow positive? And that's truly key because the property is going to pay the loan back. You as a person are not. The IRA is going to make the payments, but it's all dependent on the property cash flowing sufficiently to throw off excess cash. And I'll get into that in a minute on what does sufficient cash flow mean in my next slide or two. Is the property rent ready and in a desirable location? Well, in real estate, You know, there's the old saw about location, location, location. And we look for properties that are in low crime areas, properties that are in the similar price range of other properties in the neighborhood, near good schools, transportation, those things. But mainly also rent ready. We don't want to be financing a rehab project or a flip. What we're financing is buy and hold rental properties. So we want to be sure that the rent is sufficient to cover the cash flow and the expenses, but we also want to have it be rent ready or nearly so. If it needs a little bit of money to be rent ready, that's okay. We have a $10,000 parameter that says as long as a property doesn't need more than $10,000 in work to be rent ready, we can lend on it. You'll just use your own IRA money after purchase to make those improvements. Maybe it needs new appliances or some carpeting or some interior paint, and you can get all that knocked out for $5,000 or $6,000. That's fine. So anyway, good rent-ready property in a good location and having the necessary funds in the account. And lastly, does the property make sense? And I guess only you can answer that one as an investor. Does it make sense for your IRA to own this property as an asset? How long does this process take? Well, it's very quickly and straightforward, quite frankly. It normally takes us only 2 days to make a loan decision, yes or no, if we have all the information. And that would be a loan application and some supporting material, such as IRA statements, copy of a lease, if there is one on the property, projections and pro formas. And if it's in a condo association, we'll want to see some HOA financials. So basically, though, we can get our loan decision down to 24 to 48 hours. And then if it's yes, you as the investor send us an appraisal deposit. Then we order the appraisal and we'll close in about 30 days. So start to finish, 30 to 35 days is about average. What are some things that could potentially derail a loan or cause a loan to be declined? Probably one of the biggest things that I see is overestimating rental income. Oftentimes that's the case where an investor lives out of state from a property, and they're buying in a market that maybe they don't know real well, and they're going on maybe hearsay or some just basic information that says, oh, this property should rent for $1,500 a month. And so we'll build our whole model around a $1,500 a month income. But what if market rent is only $1,100? And here's where we'll check your work, you investors out there, is when we go to order the appraisal, we have the appraiser do what's called a rent comparable survey. And the appraiser will go out and find at least 3 rental properties similar to the subject in the neighborhood and establish what would be known as market rent. What is really market rent for this property? And that should line up with what you come up with as your projected rental income if it has never been a rental. And I guess I want to bring that point up. We can finance properties that have never been rentals before. A lot of properties that I see IRA buyers investing in have been owner occupied. So there is no rental history. So what do you do about that? You gain good knowledge from property managers and realtors, what really true expectations should be for rent income. And then you can plot your expenses, taxes, insurance, any management, any HOA fees, build that into your model. So that you ultimately have your income you expect, your expenses you expect to have, including some debt service, and then you should have net operating income being a positive figure at the end of the day. But overestimating rental income can definitely be a problem. Also, if it's the most expensive property in the neighborhood, I'd much rather finance the least expensive property in a nice neighborhood rather than the most expensive property in a less desirable neighborhood. And if a given property, let's say, is $100,000, but everything around it is $60,000, that's not going to work for us. So you want a property that the value and the sale price lines up with the surrounding properties. High crime areas, that's a real killer. High crime causes high turnover, It depresses resale prices when you go to sell. Tenants leave. It's just not a good situation. So again, avoid high crime areas. Poor condition of the property. If it is more than that 10 grand worth of work to be ready, it's not something I'm going to finance. And maybe that's okay with you as an investor. And if that's the case, I've seen people go out and buy a property they really like with all cash, fix it all up, and then come back to me for a cash out refinance. Because we can do refinances as well as purchase money loans. So consider the idea that maybe you already own property free and clear in your IRA, and you want to buy more and you don't have enough cash. Well, think in terms of maybe you're leveraging one or two of those properties you own in your IRA. We can put money back in your account. That cash will be there to purchase more real estate. Global debt service, that's if you had several loans. And any investors who've been around this space a while do have potentially a number of non-recourse loans. We as a bank must look at the global picture, all the loans that are outstanding, all the income coming in, and is the cash flow still positive to cover all the loans from all the property sources. So that's what global debt service is all about. We want to make sure that globally, or for the whole entity, the cash flow is strong enough to cover all the payments. And lastly, inadequate reserves. That's that 15% I was talking about earlier. Do you have that 15% liquidity still on the sidelines? We want to see that. So make sure that you're keeping some money on the sidelines for operating. Now, what do we offer as a product? We offer 60% financing in most states. If you look at the left side of the screen here, most states, residential properties, we're talking 1 to 4 family, we'll go 60%. And we have both 20-year fixed, and we have adjustable rate mortgages that are 25 years. On the right half of the screen there, you can see on that slide that on 5 units plus or vacation rentals, we lend 50% of purchase price. And we still have both the 20-year fixed and the 25-year adjustable rate mortgage. On commercial properties, again, it's a 50% loan to value. Same thing, 20 and 25-year financing is available. There's a few properties and kinds we don't lend on, such as hotels, motels, restaurants. But other than that, we're pretty open. I'd always encourage you to run the property by me first before you're under contract to be sure that it's something we'll be able to handle for you. And again, on commercial, property must be rent ready or nearly so. Be built after 1940. That's our age parameter, although I'll speak to that in a minute. If it's HOA financials, they must be healthy if it's at a condo or a townhome. And again, location is the property, again, in a low crime area and in an area that supports its values. So what do I mean by cash flow? Well, what we're talking here, there's a simple ratio in this area of lending that can measure whether a property is bankable or not. That's called debt service coverage ratio. What that means is the P&I payment, the debt, has to be covered at least 125% by the net operating income. In other words, the income that's left over after all the expenses are paid. So here's an example, and this is a real example. There was a $100,000 property. We have a $60,000 loan on it, and the annual payments on that loan run about $4,421 a year. Now, the net operating income for the property, this was rented at a little under $900 a month, about $900 a month. The total net income after taxes, insurance, we have a 7% vacancy factor. Any management was $7,360 a year. So you take $7,360 and you divide that by your debt service, and that comes up with a ratio of 1.66. And the metric there we want to see is at least 1.25. So as long as that property cash flows at least 1.25 or greater, it works. This next slide shows you a little clearer what I was talking about. This is a commercial property, same idea. And if you look at the right half of the slide, this was a triple net lease on a commercial property, but the same concept applies on residential. It was a $600,000 property. We made a loan of $300,000 on it, and the payments were about $26,840 a year. So at a $5,000 a month income, if you look at the right half of the slide, you can see gross income for the year was $60,000. Now we build in a 7% vacancy factor, which represents about 1 month a year that a property would be vacant. And again, use this model on your residential offerings as well as commercial. So it's just good to use these categories to build your expenses in. But there's a vacancy factor you'll want to build in. You're going to want to build in whatever the taxes are, the insurance, whatever maintenance, whatever HOA fees, whatever utilities, if you're going to pay them as the owner, and then management fees. And then that gets you down to net operating income. So in this specific case, at a $5,000 a month rent, they took in $60,000 for the year, and we subtracted out the vacancy factor. There was a small amount of maintenance because this one was a triple net lease where the tenant is going to pay the taxes, insurance, and the major maintenance items. So really there was only 3 costs to this one that the owner had to bear. That was a vacancy factor, small amount of maintenance, and then management. There was an 8% of gross management factor, so $4,800. So the net operating income out of this property was $47,400 a year. The debt service was $26,841. So there again, you take your net operating income, divide it by the debt service. That gives you your debt service coverage ratio, in this case 1.76. So there again, as an investor, you want to look for at least a 1.25 or greater debt service coverage. That means at least the bank is accepting the deal. It's a bankable deal. Now, whether you want to go ahead with it or not is up to you, but at least you know it's bankable from a debt service point of view. And that's key, because you don't want to find and buy something that you're subsidizing the payments every month out of your IRA. Your IRA should be able to make these payments out of excess cash flow every month. That's the whole idea. So that extra cash after all expenses is building up in your IRA and growing your IRA. And that's the beauty of the real estate play, is that you not only have the appreciation of the asset, but you also have recurring monthly positive cash flow income. It's like a dividend on a stock. You're getting this recurring rental income every month, more than all expenses. So that should be building your IRA up and up. As Jason mentioned, our bank, First Western Federal, has been in this space since 2008. And I started the program for the bank back then and have been running it since, with help now from Nick and some other folks here at the bank. We have really dedicated the resources of this bank toward the non-recourse field. And so we've become experts in it. This is what I do every day when I come into work, is do non-recourse lending. So if you just want to get an opinion on a property, you want to talk to a real live person, find out what are options for you, again, don't hesitate to call us. I'm Roger St. Pierre. My counterpart over here at the bank is Nick Conway. We're both available Monday through Friday. And again, our bank has been in this space since 2008. And we're here to help grow your IRAs and through adding leverage and the power of leverage. So I know there's probably questions. This is something you can follow up in the future on. And I really want to thank the folks at NewView, and particularly Jason DeBono, and all the services you provide. We have really enjoyed working with your clients over the years and hope to in the future. And again, thank you for the opportunity to present some knowledge today on non-recourse loans.
Well, Roger, thank you so much for walking through that. If you've got a minute, I got a couple of comments and maybe some items there that we can add here as we close out the webinar today.
Yes, I do, Jason.
So the first thing that I think is really critical to understand is, the world of non-recourse lending, I think is a powerful one. One of the things that's interesting is if you compare the concept of how banks and brokerages write loans, obviously they write risk-adjusted loans, and so they write loans out and they manage a risk portfolio. And I think most people would agree, maybe with the exception of some bad choices made during some economic downturns or leading into some economic downturns, banks generally are pretty conservative. What amazes me is that you cannot go to a brokerage house, a Schwab or Fidelity, and actually take out a loan to buy stocks in your retirement account. It's permissible, but none of those institutions want to take a chance on that type of loan. Yet there's multiple institutions and very well-known, public banking institutions like First Western Federal that write these loans all the time for real estate. So the first point is really to help you understand from an asset class perspective, how the world and how the banking professionals view real estate as it relates to stocks and bonds. And I think that's an important consideration. Second thing to kind of point out is, what Roger and his team have done at the bank is really awesome, because I started in this business in 2005, and in theory, non-recourse loans were great. We could talk about them all day long, but as a practical matter, they really didn't have a lot of impetus for a lot of our clients because there were very few people that would write them. Most non-recourse loans were private. Most non-recourse loans were written similar to hard money loans with significantly high interest rates. And a lot of the lenders that would write them that were more institutions would only write into very small geographic areas. First Western is one of only a handful of institutions that'll write in pretty much nationally on a variety of different products. So I think, Roger, I don't want to put you on the spot on interest rates, but, can you maybe talk a little bit about how these look, how a loan may look compared to what a traditional hard money non-recourse loan may have looked like a few years back to obtain similar type financing?
Yeah, good point, Jason. People are always surprised that the rates for this type of a sector are as reasonable as they are. Our rates range between the mid fives. I have some adjustables of 5.5 and 5 7/8 into fixed rate offerings at 6 3/4. So generally speaking, though, on our 1 to 4 family residential offerings, they're from the mid fives to the mid sixes. Really good rates. The rates in general, if you're looking at bank rates, quote unquote, in this sector, they're probably going to range around 1.5% higher than a Fannie Freddie product out there that you're going to go for a personal loan. But that small premium in rate of 1 to 1.5% is very minor, considering you're getting the whole asset income tax advantaged. It's either going to be tax free or tax deferred. So that very small premium you pay on the interest rate is more than made up by the idea that you have a tax favored account you're buying these assets in. But yes, rates are very reasonable, I think. Again, mid fives to mid sixes. Our commercial offerings are mid sixes to low sevens. But again, these rates don't change. That was the other thing I was going to say, is we haven't changed our rates since June of 2018. So these rates don't bounce up and down like secondary market rates change daily. These rates only change when there's really major movements in the short-term treasury. Our rates, just so you know, are pegged to the 1-year T-bill. So as long as that 1-year T-bill is fairly steady and not moving around a lot, our rates aren't going to move around a lot either. So again, rates are reasonable in this area, and I appreciate you bringing up that thought, Jason, just so people can have an idea about what they really are looking at.
Yeah, and this one comes up a lot, Roger, and there's a lot of misconceptions that, one, is it even possible to get a loan in an IRA? Many people think it's not because their brokerage portfolio doesn't allow it, and we talked a little bit about that. And for those that do potentially, are aware of its opportunity, they tend to think that this is hard money, and they're paying 10 and 12% for these loans, plus a lot of points up front. And a non-recourse loan is an incredibly affordable way to go out and take advantage of the power of leverage. And the thing that I like about going through the lending process is, and Roger did a really good job of highlighting this, is, it's a second set of eyes. I don't think Roger or Nick or anyone at the bank is going to, sign and stamp and tell you that the deal's foolproof. There's lots of things that can go wrong with real estate and unforeseen circumstances. But if you're going through your own process of evaluating the property and doing your due diligence on, your income and expenses and the ratios and your debt coverage and all of those things that are important to understanding and evaluating whether or not it's a good deal, you're also turning that over to another set of eyes for them to take a look at it. And maybe they look at it from the same angle, or maybe they look at it from a different one. But they sometimes can either reinforce your decision and help you know that they didn't discover any landmines that you overlooked, or they may even point out a landmine or two that allows you not necessarily to walk away from the deal, but certainly to go back and make sure that you're considering that. And I think you'll find, if you're looking for leverage, that having that extra set of eyes is certainly a nice bit of comfort and a little bit of extra reassurance before you go into that deal, that you've crossed your T's and dotted your I's.
That is an excellent point, because in this world, the bank has as much at stake as the investor, more or less. We're about a 50-50, 40-60 partner, and we're a portfolio lender. I mentioned that earlier. We don't sell these loans. So unlike a loan on the secondary market where you go to a broker or a bank and they're going to originate the loan, and now that loan's sold, they don't really care. That bank, if it qualifies on the very basic ideas of the qualification process, they don't care what that thing really is going to look like, because they're selling the loan. Here is a different situation. We got to live with this loan for 20 years or 10 years or 5 years or however long that you as the investor want to hold that asset. So we have a lot at stake into making sure it's an asset that we want to put on the books. And sometimes there's deals where we don't like the deal, but the investor wants to do the deal anyway. Hey, we're not saying that you shouldn't do the deal if we see some red flags. All we're going to do is point out the idea that there are some red flags. Here they are, and you ought to think about them. And if there's so many red flags, we don't want to do the deal, maybe that's something you really ought to consider. But on the other hand, on the positive side, if we look at a deal, we don't see anything wrong with it. We see good cash flow. It's in a good area. I agree with you, Jason. Here's a second opinion that you're making a good decision, because the asset not only passed your scrutiny, but it passed another bank scrutiny who's going to live with this deal. And we've been writing these loans a long time. So if we like it, it's probably a pretty solid piece of property.
Thanks for that, Roger. The consideration of doing a deal, without a doubt, is a tough one, and having that extra set of eyes, as kind of Roger pointed out, with what they're looking for in his presentation, can be an invaluable service on the way to using this financing option. The last or second to last thing that I think is important to kind of cover and walk through is that, I won't speak, and I certainly won't put Roger on the spot, and I won't speak for him, but as a custodian, we have hundreds and hundreds of clients who currently have and have over the years taken out non-recourse loans. And one of the things that always amazes me is that I can count on, probably one hand, and don't quote me on that, but the number of these properties that have gone through the foreclosure process. And I think that speaks a lot of volumes to both the criteria of institutions and other individual lenders like Roger's group. I think it speaks to the level of due diligence and effort that's put in by our clients. And I also think it speaks to the concept of the rental real estate market world in general. And While I'm not here to say it's the best investment and where you should put your money, but I think as we all kind of question where this market is going and what kind of economic uncertainty may or may not lie ahead, I think everybody still has the remembrance of 2008 and 9 and the Great Recession that ensued. And if you go back even through that period, the foreclosure process on these loans is no different than it is today, which people would say is a phenomenal rental market, peak rents and that sort of thing. And the reason for that is these deals, when you're putting enough money down, even in good times and in bad times, should create a surplus. You shouldn't be paying your rent out of your IRA balance. You should be paying your rent out of the income that this property produces. And if you're crunching your numbers right, with the exception of vacancies, you should always be cash flowing positive, especially if you're putting 40% down. So I share that because I get this question a lot about, man, I bet you got, had a lot of clients lose properties during the last downturn. And the answer is absolutely the opposite. Our clients that owned properties in 2005, which at least for here in Florida represented really the peak of the market, while they saw their underlying asset value drop, believe it or not, the rental market, because so many people were displaced from their homes, was actually growing. And we have clients that made more money on their rental in 2008, 9, and 10 than they ever anticipated making, given the economic conditions that we were in. So while I'm not saying, it's the best and foolproof, there is something to be said about an annualized cash flow. And even though the asset itself, even if it loses value, if it's stable from a rent standpoint and you're able to maintain that rental capacity, the annual income can't be recovered. Whereas a loss of appreciation over a few years can be recovered with a few years of growth. And we're seeing that in the stock market with people that lost money in 5, 6, 7, and then recouped it back in 12, 13, and have since maybe even made more on it. But what has to be factored in is that same real estate owner with the same investment and leverage, making that investment in 05 or 06, they had cash flow for all those years that your stock investments didn't produce. And so if you were to compare the math and the ROI over that period of time, our clients in real estate, especially those with leverage, have generated significant returns and have put themselves in a position to not just sell to recoup their income, but sell to turn a profit on both the appreciation side along with what they've accumulated over the years. And there's a lot of stock investors that are able to sell and generate some appreciation, but they got nothing to show for it for all the years that it was reduced in value, no dividend, no income. So it's a powerful, powerful tool that, in my opinion, should be carefully considered and understood. And the last thing I just want to mention as we wrap up, and Roger, thank you so much for your time and expertise today. You certainly have a grasp and understanding on the non-recourse loan market, and we thank you for being here. One of the things that comes with non-recourse loans is a potential tax in the IRA. It's called UDFI, Unrelated Debt Financed Income. You may hear people refer to it as UBIT, Unrelated Business Income Tax. They both really say the same thing, but technically apply in two different areas, kind of like tax cousins, if you will. But we have a special webinar that is upcoming. You can take a look and download it on our website once we run it, on the tax implications and how UBIT and UDFI can and may impact your investments. So it is not enough to keep you from doing a deal, just like you wouldn't not go out and buy a piece of real estate today because you may have a capital gains tax upon sale. But like any tax, it's important to know it understands and know its place so it can be factored into the decision-making process. So we're not going to dig any deeper in it today, other than to simply put a stake in the ground to say it may exist in non-recourse loan situations. But that webinar will cover in detail when and if it applies, and how to get a basic level of understanding of its calculation. So with all of that said, Roger, thank you so much. Your presentation was excellent and shed a tremendous amount of light on what that non-recourse loan market looks like. I would encourage any of the clients or potential clients that are on today's webinar or listening to it after the fact to do your due diligence. Certainly reach out to Roger or Nick as resources. And And if you have questions on the IRA side, please let us know. We're happy to talk you through that process as well. So, Roger, thanks so much for being here.
Thank you, Jason, and you folks have a great day. I appreciate the opportunity.